pricing a coupon bond as a sum of zero coupon bonds. Now we're going to consider bonds that pay no coupons and simply mature in a certain number of years by repaying the face value of, say, $1,000. This kind of bond is a one-shot payment called a zero coupon bond. How much would it cost? Well, the first thing to note is that anyone issuing such a bond, even the US government, would have to sell the bond for less than $1,000, as long as interest rates on longer-term safe securities are positive, which they almost always are. The present value of a zero coupon bond maturing in T periods is C sub T, the cash flow at time T, divided by 1 plus R sub T to the power of T. I wrote the subscript, capital T, in the discount rate R sub capital T to specify that this is the appropriate discount rate for a zero coupon bond maturing in capital T periods. If the equivalent annual discount rate had been 2%, which would be a 1% semi-annual yield to maturity, when the bond was issued, then this bond would cost $819.54. If the annual discount rate were 2.04% or 1.02% semi-annual yield to maturity, then this bond would cost $816.31. Now let's go back to the coupon bond. This coupon bond paid 20 annual coupons of $10 each, and then the last period also repaid $1,000 in principal, and each of these also had a present value based on the bond's overall yield to maturity. But here's the key insight. This coupon bond is just like a series of 20 zero coupon bonds. 19 of them pay off $10, and one pays off $1,010. It's as though the investor has bought 20 zero coupon bonds maturing every month. Or you can think of it as 21 zero coupon bonds, 20 little ones paying off the $10 coupons, and one paying off $1,000 at the same time period as the very last coupon. It turns out that if each of those little bonds traded separately, they would not have the same yield to maturity as one another. In fact, their present values would be different from the present values we calculated at the coupon bond's overall yield to maturity. This phenomenon is called the term structure of interest rates. The fact that a yield on a pure one-year payment is different from, and usually less than, a yield on a pure two-year payment, which is different from, and usually less than, the yield on a pure three-year payment, and so on. Bond traders have carved up treasury bonds like this for a long time. The procedure of breaking down a coupon bond into its components is called coupon stripping. This coupon bond would actually be broken down into 21 pieces, 20 little coupons, each paying $10, and one principal repayment, paying $1,000. Those securities can then be sold separately, and in doing so, one learns how much the market would be willing to pay for promises at each different time horizon. The Treasury itself does not issue these bonds, but it does allow the Federal Reserve to hold these securities under the STRIPS program. STRIPS stands for Separate Trading of Registered Interest and Principal Securities, a convenient acronym that evokes the stripping of the coupon bonds that takes place. The Wall Street Journal website provides prices of STRIPS. This information tells us exactly what the prices and yields are of the different cash flows that comprise a coupon bond. 20 coupon cash flows and one repayment of principal at the end. Now this is interesting. You might wonder why there is a different yield to maturity for the February 15, 2023 coupon payment versus the February 15, 2023 principal. Well, that's related to differential tax treatment of these two pieces. For individuals, the coupons are taxed as ordinary income, while on the principal, only capital gains tax would be owed. Since a coupon bond can be thought of as a series of zero coupon bonds, we can just add up the prices of the strips here, multiplied by the appropriate payment size, to get the total present value of the coupon bond in the example. That is, these prices are per $100 of face value, but for the coupon bond we really have 20 coupons with face value of $10, plus one principal repayment with face value of $1,000. So for each coupon, we need 1/10 of the quoted strips price at the relevant horizon. The near-term ones will then be worth close to $10 each, and the long-term ones will be worth more like $8 each. And for the big principal repayment in 2023, we need 10 times the quoted strips price, so $820 instead of $82. By the way, since these instruments are traded in markets, there is both a bid price, which is what dealers are offering to pay for the securities, and an ask price, which is the price at which they're willing to sell the security. I'm going to use the bid prices here. And if we add up all of the appropriately scaled bid prices, we find that the total at which bond dealers would buy this stream of cash flows equals $1,006.53. That's very close to, just a shade below, the quoted price for the coupon bond of $1,006.55. This set of zero coupon bonds can be thought of as a synthetic version of the coupon bond. Observe that the earlier payments are actually worth more, they are discounted less, when we use this term structure of interest rates than when we use the bond's flat overall yield to maturity of 1.939%. And the last few payments, including the big repayment of principal at the end, are actually worth less, they are discounted more, when we use this term structure of interest rates than when we use the overall yield to maturity of 1.939%. So we can rewrite the bond present value formula as follows. The present value equals the first coupon payment divided by 1 plus R sub 1, which is the annualized yield on a 1-year zero coupon treasury bond, plus the second coupon payment divided by 1 plus R sub 2, which is the annualized yield on a 2-year zero coupon payment, and so on for the cash flows of the bond. Now, those subscripted numbers in the interest rates in the denominator have deep meaning. Markets apply different annualized interest rates to payments that are made at different horizons. In normal times, generally R sub 1 is less than R sub 2, which is less than R sub 3, and so on. So we've seen in these zero coupon or one-shot securities that the yield to maturity rises with the time horizon. The yield on a 10-year bond is higher than the yield on a 5-year bond, which is higher than the yield on a 1-year bond. This is not always the case, but it is more often the case than not. There is some debate as to exactly why this is, but the consensus is that it has to do with risk and the liquidity premium. Investing in longer-term bonds exposes you to a greater degree of inflation risk. If you bought shorter-term bonds and there was a lot of inflation, those bonds will at least mature sooner, and you can invest in higher-yielding securities when they do. Other things equal, you also prefer instruments that you are less likely to have to sell at a loss. That liquidity preference would push investors towards shorter-term bonds over longer-term bonds, pushing up the relative yields of the longer-term bonds and pushing down their prices. The greater these risk and liquidity concerns, the lower the price of a bond and the higher the yield. And it's generally the case that these risk and liquidity concerns are stronger for very long-term promises.